If you bought silver at $86 on December 28th, congratulations, you just took a crash course in emotional damage. In less than 48 hours, you were down 17%. And if you panicked and dumped everything at $70, you literally sold the bottom and then had to sit there watching it bounce to $78 without you. Brutal. And if you're sitting right now wondering, should I buy? Should I sell? Should I just pretend this never happened? Don't move, because what just happened in silver was not random, not normal, and definitely not accidental. Silver hit a brand new all-time high of $86.62 per ounce on December 28, 2025. 2 days later, $70. $16 evaporated in 2 trading sessions. That's not a dip. That's a controlled demolition. Silver didn't just have a good year, silver had a historic year. Up more than 150%, outperforming gold, outperforming stocks, outperforming basically every asset with a pulse. Why? Because the industrial world had gone full goblin mode for silver. Solar companies, EV manufacturers, chip factories, they weren't buying for fun. They were buying because without silver, their production stops. Period. Then December 28th happened. Silver futures opened, and the price blasted upward. Social media lost its mind. People were screaming, 100 incoming, 150 easy, 200 by next year. The hype was unreal. And that's when the trapdoor opened. The Chicago Mercantile Exchange quietly dropped a bomb. A 13.6% margin hike on silver futures, effective immediately. Traders with leveraged positions were told, pay up thousands more per contract right now or get liquidated. And here's the twist. This wasn't announced at 2 p.m. on a normal Tuesday. It was during the holiday dead zone. Big traders on vacation, low liquidity, robots running the show. Margin call plus thin liquidity equals forced selling tsunami. Silver didn't gently drift lower. It fell off a cliff. $86.80 for $80, $75, $70.5. Retail traders equals obliterated. Stop losses equals chain reacting like dominoes. Institutions equals chilling at $70 with limit orders ready to feast. That whole thing, that has a name. Liquidation cascade. And cascades rarely just happen. Cascades are triggered. Now before we go deeper, relax. This isn't financial advice. I'm not telling you to buy, sell, hold, or pray. Silver trades like a battlefield, not a retirement plan. And the story is only getting spicy now. Because while the paper price was melting, something bizarre happened in the physical world. Nobody lowered their prices. Dealers were still charging $76.80 for coins and bars. Some ran out of stock entirely. Websites lagged from traffic. If this crash was real, you'd see people panic selling physical silver to dealers. Instead, industrial buyers said, "Oh, 14% discount. Don't mind if we do." And they bought everything in sight. Why? Because silver has been in a 5-year structural supply deficit. Demand supply every single year. You can't fix that with a tweet. You need new mines. Mines take 5 to 10 years. Then comes the China twist. On January 1st, 2026, China rolled out new export licensing for silver. Translation: if we refine it, we keep it. Their solar and EV sectors are massive. Restricting exports takes huge supply of the global market. Shanghai silver started trading at a premium to London and New York. When the futures price crashed, Chinese buyers didn't cry, they loaded up. That's not what a dying market looks like. Now, the leverage part. Silver wasn't just being bought, it was being gambled on. 10x, 20x, even 50x leverage. With 50x leverage, a 2% dip deletes you. A 10% drop, game over, account gone. Thanks for playing. CME saw the leverage. Hit the margin button. Weak hands got flushed, and suddenly the market was healthier. Because here is the part most retail traders never understand. Volatility is the price of admission in a bull market. You want silver from $30 to $100. It's not going to politely walk there. It will explode upward, nuke downward, shake out tourists, test everyone's conviction, and then reward the survivors. After the crash, silver bounced $70 to $76 in a single day, consolidated in the 70s, and even at 71.72, it was still up 140% year to date. The bull market didn't die. It just kicked out the tourists. Now, we've got 3 roads. Scenario 1. Bullish 70 holds. Grind higher. Retest 8086. Breakout toward 100 plus. Scenario 2. Neutral choppy sideways. Slow bleed. Settle around 60-65 for months. Scenario 3. Catalyst shock bank margin failure. Export restrictions. Strategic silver reserves. Any of those could send it screaming in either direction. Bubble? Depends. If you YOLO'd at $86 on leverage and blew up at $70, yes, that was your bubble. If you've been stacking from 2030, this is just Tuesday. The fundamentals are still solid. Supply deficit, industrial demand, geopolitical stress, monetary debasement, China tightening exports. Those didn't vanish because of a 48-hour shakeout. Smart money isn't panicking. They're watching $70. If it holds, they buy. If it breaks, they wait for $60. But they're not walking away. CME's move, legal, yes. Fair, debatable. Margin hikes have a funny habit of bailing out short sellers exactly when they need it. 1980, 2011, 2025. The pattern is real, and that's why the veterans always say, if you don't hold it, you don't own it. Paper silver can be liquidated. Physical silver cannot. We are at an inflection point. The crash was the shakeout. The next move is the opportunity. When paper and physical finally decouple, and one day they will, that is when real price discovery begins. Stay calm. Stay sharp. This game isn't over. Not even close.